Hello and welcome back. If you are new here, my name is Jessica Abella. I am a tax professional practicing in the greater Seattle area. And today we're going to talk about 5 things to consider doing before December 31st for tax year 2024. So the first thing you might want to consider is if you are looking at purchasing a new vehicle and you are interested in an electric vehicle, you may want to consider purchasing that before December 31st. There's been some talk that the incoming presidential administration would like to end electric vehicle credits. And so that $7,500 credit may cease to exist in the future. We don't know that, but it is possible. So if your income is under $300,000 and you are a married couple, or under $150,000 and you are single, consider looking into the EV credit and if it may make sense for you to purchase before the end of the year. Number 2, charitable donations. So if you intend to deduct charitable donations, they need to be done before December 31st. Note that they will only help you if you are itemizing deductions, and with the higher standard deductions we've had in recent years, it's less likely that you are. So definitely make sure that you are itemizing and that they will actually help you before you make that donation. But one strategy with donations is to lump them together. If you would normally donate $10,000 across 2 years, doing it all in 1 year will give you more of a tax benefit than doing $5,000 this year and $5,000 next year, if you are on that line where you may or may not be itemizing. Similarly, with donations, if you are over age 70 and a half and you have IRAs, doing a qualified charitable distribution from your IRA escapes tax on those IRA dollars. So the funds go directly from your IRA administrator, Fidelity, or whoever is holding that IRA, directly to the charitable organization. You don't have to include that income on your tax return. It also satisfies your requirement if you have a required minimum distribution. So those are the first 2. The third one would be to maximize your retirement contributions. So if you look at your pay stub and find that you have not contributed the maximum to your 401k, which would be $23,000 for 2024, if you're over 50, you get to contribute an additional $7,500 on top of that. It may be too late with only a pay period or 2 maybe left in the year, but to try to bump up your contributions, get as much into that 401k as you can. If you will be funding an IRA or a Roth IRA, you have until the due date of the tax return to do that. So you have until April 15th to do that. But 401k contributions have to be done by December 31st. The next thing would be if you have a sizable estate that you are needing to start transitioning to the next generation, make sure that you have done your annual gifting. You can give up to $18,000 per year per person to anyone that you would like, and that will draw down on the assets available in your estate. Right now, the estate tax limit, you can die with $13 million worth of stuff in your estate, and your estate won't pay any federal estate tax. However, that higher limit is scheduled to drop back down in 2026. We don't know that that will happen. Again, Congress needs to act to stop that from happening. We'll see what they do over the next year. The first thing to do would be to work on doing those $18,000 a year distributions to your family members, if you are so inclined. You can also give to charity to bring your estate down, and to at least that gives you a tax deduction. And the last thing I wanted to mention today is capital loss harvesting. If you have sold stock at a profit over the course of the year, you may want to look at your portfolio and sell some things that are underperforming and have lost money. Those losses will net against the profits. Do note, though, that whatever that net is, if that net loss is more than $3,000, you'll get the benefit of a $3,000 loss. The rest of the losses will carry forward into the following taxable year. So just keep that in mind. Don't sell a bunch of losses when you don't have any profits to offset. Just unless it's the right thing to do for your portfolio. Obviously, do what's best for your portfolio. I'm not a financial advisor. I can't give you investment advice. But from a tax perspective, if you do have things in your portfolio that you would like to get rid of that have lost money and you have gains, offsetting the two would be fantastic. Those are the top 5 things that I would consider for December 31st. Let me know if you have questions. Certainly, each of these has intricacies and gray areas. Be sure to consult your tax professional if you need clarity on how that actually impacts your tax situation. If you have questions about any other tax topic, feel free to leave those in the comments down below. Like the video if it was helpful, and subscribe if you'd like to be notified of next week's video. I hope you're having a lovely holiday season, and we'll see you back here next week.